Let's pull up shares of Oracle because it's an interesting developing story as we have this conversation. And you could see a little while ago, these shares took a dip by about 5%. The information is out with a story today which says the following. I'm quoting directly from this story, and this is the reason why the stock is lower. Internal documents show the fast-growing cloud business has had razor-thin gross profit margins in the past year or so, lower than what many equity analysts have estimated. That could raise questions about whether the AI cloud expansions undertaken by Oracle and its rivals will affect profitability and sustain investors' expectations. So this really speaks to what you're talking about. But here we have, according to the information, and we're continuing to work on this, and we'll try and get you more in just a little bit. Nebius is down on this. You're looking at related names, really at a time where we are, as an investor class, sort of really trying to get an idea where we are. Whether there's a bubble, whether there's been too much spend, whether there's been too much speculation on what the spend will result in. And at least this story right now about Oracle is sending those shares lower. There's CoreWeave, which took a move lower on that as well. Josh, I didn't mean to interrupt you, but I don't want to sit on that as we watch that stock go down.
I appreciate you bringing that into the conversation because that is exactly what it looks like when some air is let out of these types of bubbles. And the main point that I wanted to make, and I'll make it right now very briefly, so I know we have a lot to get to, is that not every bubble ends in a 2000 to 2002 style secular bear market that takes the S&P down 57%. That's not how most of the time these things end. Most of the time, you'll just see certain names blow up. You'll see valuations contract. You'll see a couple of years of sluggish share price growth as we digest some of the excess. It doesn't always have to be the NASDAQ down 85%. People think there's this binary thing where either the market triples or gets cut in half. And most of market history says otherwise. It's okay if certain people are paying certain high multiples for certain stocks, and then that ends. It doesn't mean all of us have to go through Great Depression Part 2. So there's room to say a lot of this activity is justified, while you can also say there are some people doing some insane things. It'll all come out in the wash, and I think investors will be okay.
Joe, you got shares of Oracle. Jim, you do too. But this is about how much money Oracle is generating from the rental of its servers that are powered by Nvidia chips, and that the gross margins are perhaps lower, according to the information, than some analysts have modeled in, which is one of the reasons, obviously, there's been so much optimism around this name. If you broaden this chart out, guys, if you could, back to around the earnings report, and there it is. I mean, you can see that the move higher there on the left-hand side of your chart. Remember, the stock exploded higher the day that this company reported earnings. So, you know, that's the move you're looking at. You own the stock. What do you think about this?
I think that's the euphoria. I think it's represented on September 10th. You know, Josh is talking about a bubble. Sir John Templeton talks about the stages of a bull market. The last stage is euphoria. And in certain areas of the market, there will be euphoria. And I think Oracle is a classic example of that. September 9th to September 10th, a parabolic 40+% move higher, and then the dramatic steady retracement ever since. Why? Because the spending here is being done by debt. And that is not what the market should be encouraged by. What the market previously had been encouraged by in the early stages of 25 and in 2024 is that free cash flow was the catalyst behind a lot of the spending. You don't want to see this evolve into a debt-driven cash spend on CapEx. That's troubling for the market, and I think it's clearly represented here. I understand why Oracle did what they did in signing the deal. They need to suffer in the near term with their profit margins for long-term profitability. But in reality, for them, maybe they are not best positioned like a Google is or like an Amazon to accept that type of financial dynamic.
So there have already, Jim, been some concerns in the marketplace about, you know, so-called circular investments. There was an NBC News story that I thought laid this out. Very easy to understand for people if you're wondering, well, what exactly does that mean? So Nvidia plans to invest in OpenAI, which is buying cloud computing from Oracle, which is buying chips from Nvidia, which has a stake in CoreWeave, which is providing AI infrastructure to OpenAI. Right? You come all the way around the circle. AMD did their thing yesterday, right? That stock's higher yet again today. That stock just exploded higher yesterday as well, which only adds to the conversation about whether there's this massive bubble brewing in this space.
I think it's legitimate to ask the question. I don't think we're going to be able to answer it right now. To me, just based on history, being in the markets, being in business, this feels a little bit like it rhymes with the late 1990s, but not with 1999, more with 1997. I don't want to be blasé, but that's just what it feels like. Now, why do I say that? Because this circular revenue stream, which is a good way of describing it, at all stations along the arc does seem to have a positive ROI, return on investment. Yes, there are questions today. Let's face it that they are rumors, but they are questions about the degree of profitability, but we're not talking about losing money at any point along which this circular money travels. I am a believer in the velocity of money theory of economic growth. I mean, it's a take on Milton Friedman. It's usually applied to the economy at large, but I think we can apply it to the AI ecosystem, given how important that ecosystem is to the economy at large. And as long as this money is flowing and making profits along the way, which it is, we should be fine. Now, for a case like Oracle today, all right, here's a stock that's trading in the mid-40s as a forward earnings multiple. It's up 120% over the last 6 months. It's susceptible to have some air let out of the balloon, as Josh just said. I think that's a good way of stating it. You let a little air out of the balloon so it doesn't pop, and it actually sets up for the balloon to be expanded further down the line. What I'm saying here, just to summarize, feels like 97, not 99. Go ahead, Josh.
You want that skepticism. Thank God they're writing articles like that.
Agreed.
You want that because in the absence of skepticism, this thing goes parabolic. You're at like a Nasdaq 30,000, Dow 65,000. That's not a good outcome for anyone. And so far, as bullish as people are, we've staved off that particular concern that I would definitely share if we were doing that in markets. But the reality is not that. And when people point out things like IREN and CoreWeave, I just default to saying, look, man, these are not the biggest market caps in the stock market. They could get cut in half and the market could survive.
Let's put it another way, taking what you're saying. I mean, Oracle right now, 40 times forward earnings. When the bubble in Cisco hit, it was 120 times earnings. By the way, I looked the other day at eBay. I think that's one of your favorites. Back at the same time, it was 400 times earnings. That's what bubbles look like. Yeah. Now, the 40 times is projected to go to 24 times for Oracle over the next 2 years. That is the question. Does OpenAI raise the funds, whether it's revenue or investments, to actually make all this cash come through the circle? That's the question that has to be answered, and it can't be answered by me or anyone, not today.
Let's bring in Christina Partsenevelos, who can add some insight, perhaps, and she follows the space obviously so closely. What do you make of this information report, which is having a dramatic impact on several stocks? Look, that caused the Nasdaq, which is now down 0.8% on this news.
I think it's interesting the news comes out the week before Oracle's hosting their big analyst day on Thursday, which for sure, this is going to be a question, right? Specifically, margins on these chips. Margins compared Blackwell versus Hopper. We know that Blackwell is the more expensive chip. And so the overarching theme for this piece is that renting these chips may not provide the greatest ROI that we initially thought. But this is just one story, right? One source. Oracle declined to comment so far, and my assumption is that they will have something to share next week. Whether it's good or bad, we don't know. But the other thing I was thinking about, you guys are just talking about leverage, right? Oracle stands out from the other hyperscalers given the amount of debt that it's had to take on in order to build these data centers and provide the rental. They were very oversubscribed. The proxy showed that. A source close to the deal also told me that. So clearly there's appetite. It's just, is the appetite warranted when you're taking on that much leverage? And then that also equates to CoreWeave, Nebius. These are highly levered companies. And so that's, I guess, throwing in the concerns across the board. But there's no shortage of appetite for this.
Christina, thanks.